don't think accounting will lead us into that that
Be
area.
surprised.
Well, welcome to the Deeponomics podcast, Francine. I'm very happy to have you on. And I mean, you have a very unique and diverse background, but everything, I guess, in a sense, relating to accounting and auditing, and how to be able to understand the creation of truthful and relevant financial information for investors, and making sure that there are systems in place to, I guess, assess and inspect that information, and to give the investors maybe not just information, but make sure that.
I mean, economists or empirical researchers would say, my career probably looks like a scatter plot. There's dots all over the thing, but you can actually draw a through line, and throughout, it's leveraged my accounting undergrad education, CPA, and then other skills that I've developed along the way. But I think the theme, the focus has always been accounting and audit, internal audit, external audit, any kind of assurance, compliance related activities.
Right. And now you spend a lot of your time, I guess, writing a very successful Substack called The Dig, right?
The balance has shifted over time. When I was full-time as a journalist, my work and my writing had to be for my employer.
Sure.
And I didn't write a lot of things on my own, but that was when I started teaching. So when I was in DC was when I started teaching at American University. I got the opportunity to start teaching, and so I keep doing that. But so you shift in terms of what's your primary focus. I would say I'm about 50-50 right now. I'm writing independently on The Dig. I occasionally write for other people, an op-ed or something like that. I write quite often for Chicago Booth Review. I write about other people's papers, accounting, antitrust, banking, etc. And then I teach. And the teaching has really stepped up. I'm now teaching with two schools, University of Miami and Montclair State, which is here in New Jersey. Okay. Online, some hybrid activity. I go out and visit schools all the time. I go out and talk to PhD students, et cetera, et cetera. And, if I had when I was a full-time instructor at Wharton, that was full-time, but I had time to write. And they didn't have a problem with me continuing to write. So I continued to write. But the balance kind of shifts depending on who's paying you, right?
Sure. Yeah. I understand. Can you tell me a bit about why did you start this independent blog, and how long have you been doing that?
So this is not my first independent writing initiative. I really started writing, and I came out of being a practitioner working for others in 2006, so pre-financial crisis. And that was when I left PwC. I had been on their team that did the internal audit of the firm itself. So we would go and look at that particular time, how well PwC in particular, but the larger firms in general were ready for the new regulatory regime of the PCAOB that had come in 2002 with the Sarbanes-Oxley Act. Right. So in 2005, when I joined PwC, they were just sort of getting used to this and building up the infrastructure of how are they going to respond to this regulator. And I focused on looking at things like auditor independence in the national office, consultations, partner matters. In other words, how is the firm responding to these issues so that then they could be prepared to respond to the PCAOB? And I left at the end of 2006 because, of course, that kind of job makes you wildly unpopular.
How so?
You're reviewing other people's work, partners' work. I had come from PwC from the outside, having been a managing director at KPMG and Bearing Point in the past. And, unless you're homegrown, it's hard to tell a partner what to do or that they're doing something wrong. So I decided to take a little time out and start writing. And I actually got my inspiration from someone who was writing about being a doorman in the bars, in the clubs in New York.
Oh, really?
This was a weird time where people were starting to create blogs and write sort of confessional stuff to get a book contract. And he
Hmm.
was writing about his activities being a doorman in all the hot nightclubs in New York. And he got a book contract. And he
Wow,
said,
that's
start a
cool. What a
blog.
cool inspiration. Nothing I would have guessed from someone in the accounting and auditing field. That's
Yeah,
cool.
no, he was an interesting guy. Like most people that are doormen, off-duty police person.
Mm,
Um, and but the idea was that this was a way to sidestep the gatekeepers, the traditional media gatekeepers. I wanted to get a book contract, and I wasn't affiliated with a firm or a university at that time. So how do you do that? How do you let people know what you know and what you
mm.
think? But I did sort of an idiot accountant thing, which is I started it anonymously
Oh,
because
okay.
you're afraid, you want to
Yeah,
go back to work. You're afraid
sure.
of, someone criticizing or you're saying something wrong. And then I realized after people were paying attention to it, including from outside the US, because there was nobody writing about the business of the big four from anywhere, really, in particular in the US.
Mm,
Um, and people were paying attention and they're asking, who is this person? And, how do they know this stuff? And I realized, well, this is pretty stupid. How am I going to get a book contract if nobody knows who I am? So I
mm.
have to stand by it. I have to put my name on it. And
Yeah.
so it was 2007, right before the financial crisis. I started writing this blog called Ray the Auditor, R-E the Auditors, and Ray like litigation or in reference to the auditors. And it was about the business of the big four. So the big four firms as a business model, not
Okay.
necessarily the technical stuff. And it was prime time because they came into the spotlight during the financial crisis. Not right away, but I feel I had some part in pushing that narrative that, hey, why aren't we looking at where were the auditors during all of this stuff? And
Mm,
because of that, I got opportunities to write for others, op-eds, to get quoted. And it led to then full-time writing for Forbes, American Banker, and then eventually for MarketWatch. So I never wrote the book, and I also never went back to work for any of the firms because I had sort of burned burned those bridges by being sort of a critic.
yeah, but at least someone needs to be brave enough, I guess, to take that perspective. So,
Well, brave enough, but also disconnected. You've
mm,
probably seen
yes.
the paper out now. Luigi Zingales, John Barrios, and others. There's a paper right now, working paper, talking about conflicts in economics research. And you talk about things like using proprietary data. You talk about things like getting paid by the people that you're writing about. You talk about, jobs or other kinds of financial or career incentives. And the problem is that if you know enough about the largest firms at the business level, not at the actual like technical level, but you know enough about how they work as a business, um, you're usually a retired partner or someone who continues to be beholden to the industry in some
Mm,
way, shape, or form. And in particular, if you're retired, you can't do anything else or ever disparage them because you have ongoing financial incentives and relationships. So there's very few people who've worked at a level where they know how the firms work at a business level, um, who are free to speak.
yeah, yeah. Well, thank you. As you might know, I'm deeply interested in investment theory and investment research and how investors come to make their investment decisions and what kind of information they use that they view as decision useful. And accounting is, I guess, viewed as a fundamental piece of that puzzle. Maybe not the most important these days, could be, but at least I would assume it's usually the starting point for most investors prior to making any investment decisions or credit or lending decision to a business. Maybe could we start with just going sort of back to the basics? And if I'm going to ask you, what is accounting and why do we need it?
So it's an easy question for me because it's basically the Bible of how I look at business, how I look at economic activity. And for me, it became a language in terms of how to understand and interpret how companies and executives behaved, and then how investors behaved, and even later than that, how regulators and litigators behaved.
Right.
And unfortunately, I think we've lost some of the respect and admiration for that basic accounting information. What are financial statements audited, and what is the value of audited financial statements to all of those participants? When I was teaching at Wharton, I was sort of disappointed with some of my students who said, I don't really need to understand GAAP. Cash flow is all that matters. I'm going to be making decisions as an investment banker, as a VC, as a private equity person, and all I need to know about is cash flows. Accounting is fake. It's about these rules. You can't even tell me the first principles, behind the rules. You want me to follow rules that somebody made up years ago that don't reflect, modern economic activity. However, accounting presents, in particular, accounting that follows GAAP or IFRS, the accounting rules present consistent representation of the economic activity. And what's beautiful is that if you're following the standards, that's consistent across industries, consistent across geographies, consistent across time, hopefully. And understanding when those inconsistencies pop up because standards change, because industries do things differently, because the economic environment has changed such that the way that we presented the information no longer is helpful. I think those are sort of my the things that I focus on, the things that I like figuring out and I like presenting to other people. And I'll tell you, I still believe it's a very powerful tool because companies still have to represent their economic activity in financial statements. They still have to go through the motions and play the game, even if people are making decisions nowadays on earnings reports that are unaudited and that are crowded with non-GAAP or other alternative metric information. There's lots of research. One of my favorite guys is Joe Schroeder at Indiana University, who's done a lot of work, but there's a lot of work by academics, accounting academics, talking about the impact of earnings, and why that's what people are making decisions on, and how do the crowd of alternative metrics change those decisions. How do journalists and analysts act as interpreters of that information and completely skew and distance it from the fundamental accounting information? And there's a lot of people in our profession who focus on the wonkery of how to keep refining over time the standards so that the basic information is correct. I've never really focused on that. I focus on once it's there, assuming that people are doing it correctly or not. But if they are, or if they say they are, then how is that information, what impression is that information making on investors? And also, given my time spent as a journalist, do journalists really understand that? How are they filtering or representing that information to the public? And is it distorting or is it helping? And I think that that's an interesting subject that's not, there's a lot of literature, but I don't think it's been explored from the perspective of how do things really work in the real world, in the journalism world. There's a lot of surveys, a lot of, kind of very narrowly focused interview kind of papers and stuff. But there's a level of understanding that they don't have, and it's moving so fast. Journalism is moving so fast given the influence of AI and other automated means of producing the news.
Do you think accounting is misunderstood?
Well, it's really kind of sad that in 2025 we still have journalists and even our own accounting colleagues using terms like green eye shade and bean counter.
Right.
They're using stereotypes that don't represent at all sort of the power, the range of activities that the largest global firms are involved in. And the largest global firms are involved in all of these myriad activities, from audit to M&A advisory to tax advisory to other kinds of private company advisory, IPO advisory, even acting as broker dealers. And there's just this enormous range, including getting involved in government activities and supporting the government during crises, doing things like managing assets after the financial crisis, managing assets of European governments. There's so much that the firms do that goes beyond this stereotype of some bookkeeping function with someone in green eye shades, and sort of the stereotype of the kinds of people that are involved in accounting and audit in particular, and tax. We have people who are liberal arts graduates now. We have people that are computer science or other kinds of technology people. You have business analytics is so important. Now you have other kinds of technology that's important. You have crypto that you need to understand. There's an enormous number of disciplines that are involved now in trying to provide the services that the largest global firms provide. And I think that to some extent, the firms are glad that maybe they're a little bit inscrutable, because then they have less scrutiny.
Yeah, right. Yeah, that's true. That's true. So if we try to sort of stick to the first part, what accounting information is, and if I understand you correctly, as long as we have standards, IFRS or US GAAP, and companies sticks to that, could we take the information that they produce, the financial reports, can we take them at face value?
No, clearly not, because there is an enormous amount of incentives at play in the modern company, corporation, private or public. The increase of compensation strategies that involve options or other kinds of compensation based on metrics that are not straight accounting metrics. So again, alternative metrics or other kinds of performance or operational metrics means that there are reasons why executives or those involved with the company will influence or want the results of the company to be something that may be at a distance from the actual accounting information. How much flexibility is there? Well, one of the things that's a misconception in the regular world, in the lay world, is accounting is precise, right? You follow the standards, and in every situation you should be producing the same number. No, there's an enormous amount of judgment and discretion involved. There is an enormous use of estimates, models. And so you have lots and lots of opportunity for management, or whether well-meaning or not, to be involved in shaping the narrative. And they use that word. What's the narrative? What story do we want to tell about this company? And that's one of the primary rationales for using alternative metrics. We want to tell a different story than the accounting numbers tell. The accounting numbers are too rigid, despite the fact that they have an enormous amount of discretion in how they realize those numbers in many areas. They still feel that those are too rigid because they want to produce a narrative that shapes the share price, that shapes the future, growth prospects, that shapes the picture for investors, etc.
Okay, so what if I ask you this though? If the management believes that the accounting standards are too rigid in order for them to properly inform investors of what they believe is the true story of the company, or the true potential of the company or its future investment, simply to get an increased valuation of their stocks. Or they believe that if you adjust some of the measures, as let's say they try to they adjust their EBITDA. We all know about the adjusted EBITDA. It might be the most commonly used non-GAAP measure, right? So if they do that with sort of the coming from a truthful perspective, not to manipulate, simply to give investors more information to help them get a better understanding of the business, is that do you still think it's wrong?
I think I get a bad rap as a critic, a frequent critic of non-GAAP metrics, alternative metrics. People believe that I think they're wrong in all circumstances, but that's not really the case. There's a very valid reason to use alternative metrics, and that is when you have activity, transactions, economic activity, that's an anomaly. That shouldn't really be put on the trend line on a go-forward basis, that investors and others shouldn't be paying attention to as something that they should expect to occur on a go-forward basis, whether that's negative or positive. And so making adjustments for things that are one-time situations, whatever that is, whether that's the sale of a business unit and a gain or a loss, whether that's some kind of unusual litigation settlement, whether that's some unusual restructuring because you have an economic calamity like the pandemic. I think that those are reasonable uses of alternative metrics, because you want to tell a consistent story. You want to tell a story that talks about the core operations and the core earnings capability, the core revenue capability. But where I think it goes wrong is that companies are shaping the earnings information at earnings release time in order to meet a pre-existing story that, unfortunately, reality has thrown a monkey wrench into. And they also have significant ties between executive compensation metrics, which are frequently based on adjusted EBITDA, adjusted EPS, or some other management created alternative metric that can be manipulated. Even stock compensation, which is a normal, a reasonable non-cash, adjustment to earnings, can be manipulated because management decides how many stock options to issue. Right. And they decide and review the models that are used, which are very complex for developing the expense each period. I was just talking to someone about that, another journalist the other day. Why are they doing this? Why are they changing the vesting period for these options? Yes, it's going to impact how they report earnings, whether they do it on a GAAP basis or whether they do it on an alternative basis. It's going to change the approach. Why are they doing this? Well, you have to go back and look at management's motivations about why they're changing the vesting periods, why they're giving people options with 1 year versus 4 year. There's lots of reasons for that. It's not all about manipulating the financial results. It may just be they want to give people money faster. They want to give people rewards faster. But understanding that underlying motivation is important. And so you have alternative metrics that start becoming self-serving and self-fulfilling prophecies.
Right.
Okay.
Right.
I need to smooth out the earnings. And of course, I wrote umpteen stories, lots and lots of stories at MarketWatch in particular, about companies who weren't consistent. They would have the same kind of adjustment and they would put in the positives and not the negatives. You had ones who were openly defying the guidance from the SEC, consistently adjusting revenue, which is a big, big no-no, except for under very, very, very limited circumstances. I had one case where there was an adjustment to revenue for things that were permanent write-offs. Okay, a deferred revenue purchase adjustment. It was a permanent write-off, and they were adding it back in because of a what if we had not had to follow this, terrible GAAP, which we don't agree with. Well, that's an individually tailored accounting method, and it's not allowed. But companies get away with it because the SEC doesn't have an effective way of consistently enforcing that. And frankly, it's just rampant, and it's grown so much over time that investors and others have gotten used to it and said, we want to hear the good news. We want to hear something that's going to make the share price go up. Nobody wants to hear bad news. Who benefits from hearing that a company is actually not producing the earnings that they say they are? That's the plague of a whistleblower, right? How do you be the one that bursts the bubble? It hurts everybody. So it's very, very difficult to kind of take the train off that track and start being honest. And there's, again, strategies for that. Do you take it all at once and then people forget about it? Do you do it gradually? Do you own up? Do you wait until you get prosecuted and then you get the benefit of time value of money? So lots of different things that are going on. But frankly, the use of alternative metrics in a way that I don't think is consistent with just making sure that anomalies are filtered out it's out of control. Again, the SEC and other regulators have kind of tried to keep pulling it back periodically, but now it's completely out of control, and there's a level of expectation because everybody wants the market to keep going up.
Right. But isn't if we still have audits, right? We still have auditors. Can't we trust them to make sure that companies are actually, doing what they're supposed to do and follow the rules and regulations?
Well, on the alternative metric front, auditors do not audit the alternative metrics, and they don't audit the earnings statement. So auditors on a quarterly basis are hands off. Although they are involved in reviewing the quarterly disclosures, they have to approve the quarterly disclosures that they're consistent with the narratives that the company is providing. However, then you get into the subject of, well, on an annual basis, are the auditors making sure that you have reasonable assurance, at least, that the financial statements follow GAAP or IFRS, and that there's no material misstatement or fraud? Well, despite the fact that a lot of people want to believe that since Sarbanes-Oxley, things have gotten much, much better and we haven't had a huge blow up, what we have had is we've had lots and lots and lots of blow-ups, lots and lots of frauds, lots and lots of companies pushing the envelope, and a very strong reluctance on the part of regulators and auditors to be the ones to raise their hand and stop the train. So I think that there's a lot of internal compromise that goes on. There's a lot of, again, academic research that says auditors are under pressure. Auditors have lots of reasons not to say that a company has weaknesses, control weaknesses, etc., to report things in between earnings and when the Q comes out, or to change the information between when the Q comes out and between earnings and when the Q or the K comes out. The auditors are under an enormous amount of pressure. Some of them are under pressure and they can't overcome that because of institutional constraints. Right. Some of them are not under pressure because they're complicit in the situation. They're business people. They want to retain the client. They want to retain the relationship. And they kind of keep going along and getting along and pushing, kicking the can down the road and hoping that it doesn't blow up on their watch.
Right. So there's this huge conflict of interest, sounds like, for an audit partner, right? Keeping the business, but still being sort of making sure that their client is following all the rules. And if they're not, why would you bring it up if you could lose a client?
Right. It's a taboo subject in the academy because you have many people who are academics who have been in the firms. There are people who feel very strongly about the profession, which I do, but from a different perspective. I want the profession to live up to its goals and its ethics and its professional standards. There are others that don't want anybody to ever say that anybody could possibly do anything wrong or be complicit because it's anathema to sort of their idealistic version of what we are as professionals.
Right.
But we're not capitalist eunuchs. Okay, we are not immune to the incentives and the pressures that any normal human being it could be put under. And especially now with the growth of the firms, the largest firms are, global businesses, billions, hundreds of billions of dollars between the four. You have an enormous amount of pressure to, build that business, to build your business, to build your little part of the world with your clients, to maintain those clients. And there's, again, lots of academic research that says individual partners and firms are punished by clients for highlighting things like material weaknesses, for highlighting things like going concern opinions, for highlighting issues in between the earnings report and the Q or the K that change the earnings narrative, for resigning noisily and stating that the company can't be trusted. I mean, that happens. It's happened recently. It doesn't happen very often, but it is happening, and it does happen. And there are auditors and audit firms that say, this is we can't trust this company or its executives anymore to give us the truth. We need to walk out. But what happens? Another firm comes right in behind them because they can get higher fees given the heightened level of risk.
Oh, interesting. Okay, so what would you say? What would you say to an investor who is skeptic about the audit process and how to go about even understanding the audit quality? Let's say I'm looking into a company. I know obviously they're being audited, and I want to understand, how can I trust this? Is there a measure for audit quality?
Well, I'm a stakeholder person versus a shareholder person. I believe that a company owes something not only to its shareholders, but also to its customers, its vendors, its employees, the community that it operates in, and potentially taxpayers if it's gaining subsidies or having other kinds of advantages. And if it's a taxpayer, that it's paying fair taxes. So when I look and say, what should investors be looking at? How should they scrutinize a company and whether or not it's telling them the truth and they should invest in it or not? I would say it's a very difficult thing right now. It's a very, very difficult thing, whether you're a shareholder, an employee, an investor, a vendor, someone in the community that's counting on the company to continue to add economic activity to your community. Certainly, if you're going to be a professional investor and invest in individual stocks, you should be much better versed in accounting and how companies can or can't manipulate the information that they're providing than a lot of the investors that I see. I think that the best educated investors are, in some cases, the short sellers.
Yeah.
The people that are actually looking and saying, what is it about this company that isn't right? They're actually looking at it from the critical perspective, and they want the company to prove it. And if the company is not being transparent, if their disclosures are crap, if they don't want to talk to outsiders, if they're glossing over information, if they're inconsistent, if they seem to always be getting in trouble with the regulators, getting comment letters from the regulators, getting litigation from outside investors, then, maybe you should, those are red flags. Maybe you should take that as a grain of salt, that you really can't count on this company to do what they say. And that there are things that are probably going on in the background, but also that company is making itself vulnerable to those that might want to take advantage of it, whether it's hackers, whether it's internal or external fraud actors, or whether it's people that are just not getting good guidance or being well trained within the company in order to follow its policies and procedures and produce information on a consistent, regular basis. So I say, if they tell you who they are or don't want to tell you who they are, then you should believe them. And don't invest in individual companies. But, the standard investment advice these days is, if you can't be that person and really get into the nitty-gritty and really educate yourself and really understand and take, in some cases, a skeptical perspective, If you're just a yes man, a rah-rah investor type person, like people that, join the cult of Tesla or the cult of Berkshire Hathaway or something like that, and they can't look at the warts, they can't look at the negatives, then you should just invest in index funds.
Right, right. Okay, so do you believe there are, if we look at sort of the current regulation when it comes to auditors, and I know there's a lot of debate going on right now in the U.S. in regards to the PCAOB, and it's if it should be included in the SEC or not. It should be a standalone independent entity. Where do you think we have enough regulation to make sure the auditors are doing their job? And if so, and can you maybe you can elaborate a bit on your stance on the current debate, PCAOB?
So it's a really interesting time right now because here in the United States, and I think in other parts of the world that followed the model of the Sarbanes-Oxley legislation after the dot-com and sort of the 1999, 2000, 2001 sort of overvaluation of a lot of companies and sort of the boom period where a lot of companies, did not deliver on their promises. So a lot of other countries followed this, this approach to varying degrees. Japan, the UK, Germany, et cetera, in Europe. But in the US, there was this sort of feeling like, okay, we have Sarbanes-Oxley now. We have these new regulations that have, sort of brought the auditors back to, the beginning and reminded them of their obligations and responsibilities. And we've created a regulator that's an independent regulator, a quasi-government regulator, to inspect the audits and look and see whether or not the audits are being done properly. And it's not a peer review anymore. So it's not a self-regulatory environment. It was such an enormously profound change. I lived through that because I started when it was a self-regulatory environment, and then I saw that change in the early 2000s. But there were people on all sides who never liked that. Why? Because both companies and the audit firms like to have wiggle room. They don't want the regulation of how they do the audit and how they present the financial statements to be rigid and strict. They want to be able to respond to changes in their environment. They want to be able to make decisions, use discretion. And so the idea that someone was going to come in and look at how auditors were doing their jobs, think about financial information integrity as sort of a three-legged stool. You have the integrity of the information as it's provided within the company. Good people, good training, good policy and procedure, good documentation, good systems, good oversight by things like internal audit and the management and the board. So you have integrity within the organization. Okay. Then you have the second leg of the stool to ensure integrity for the investor or for the outside user of the information. You have the external auditor. The external auditor has access to all of that information theoretically, right? They can come in from the outside, but still with the ability to look at anything they want. They have the authority to review anything up to whatever. However, that's a push-pull, right? That's a business relationship. That's negotiated.
Right.
Okay, they get paid a certain fee based on designing a certain scope. That scope has to be agreed to by the company. Obviously, it has to be within the standards. You can't sign an audit opinion unless it follows the standards. But there's a lot of wiggle room there, in particular scope. Scope of business units, scope of testing, scope of materiality, etc. So you're waiting for the auditors to reassure you that everything that the company does on the inside is good. And you're hoping that the external auditors are performing that task the right way, according to the standards, and not being compromised by all of the human frailties. What's the third? External regulation of the audit process. And that comes from not only an external regulator like the PCAOB, but also litigation by regulators like the SEC and also private litigation.
Right.
So you have this kind of ecosystem that is at each time giving the other the benefit of the doubt. But at some point, somebody has to say whether or not that benefit of the doubt is deserved. The external auditor should say whether or not the benefit of the doubt for management is deserved, and they're supposed to come at that with a skepticism. They're not supposed to come at it from the perspective of these are good people, they do good work, and unless or until we, something pops up, we're not going to, ding them.
Right.
Okay, they're supposed to be skeptical from day one. It's supposed to be an adversarial relationship, and I think that's been lost.
Yeah.
Secondly, you have then regulators looking at whether the auditors are doing a job. And because we know that there's an inherent conflict based on how auditors are paid and this business relationship, you have to have an external review of whether they're doing their job. So you ask, well, what are the audit quality indicators? There's been a lot of academic research of late looking at, input audit quality indicators, output audit quality indicators. What is the perspective of audit quality from the auditor? Like, what does the auditor think is a good audit? What does the company think is a good audit? What do investors think is a good audit? What do what does the normal business person or reader of business journalism think is a good audit? And it's wildly different. You have academics who look at and do papers, reams and reams of papers, and they pick audit quality tests because data is available using things like, did the company have restatements? Did the company have a going concern opinion? Did the company use abnormal accruals or try to hit earnings targets? What are the audit fees? Are audit fees a signal of audit quality? In other words, if you have higher fees, there must be higher risk. If you have lower fees, there must be smooth sailing, right? All of that stuff has been completely corrupted, right? Abnormal accruals, I think, is totally invalid because everybody uses non-GAAP. Nobody manipulates the books via GAAP accounting anymore.
Oh, interesting.
Because you can have anything in the GAAP numbers, and you can change it by just creating adjustments and alternative metrics. You can change the narrative, and nobody reads the Q, nobody reads the K. Oh,
really?
Except for the short sellers, maybe.
Right.
Or me. Okay. And my friend Olga, used by my collaborator at Deeponomics. Right. And so you never, you don't ever have to worry about what's in the actual GAAP numbers or IFRS numbers because the company is telling you a different story using all kinds of alternative metrics. And frankly, the analysts are using those in order to set guidance or set estimates. So the reporting is based on those alternative metrics. If you look at any kind of journalism about earnings, it's not about the GAAP numbers. It's probably 95% of the time they're quoting what the company says about alternative metrics.
Right.
Alternative adjusted EPS, adjusted revenue, whether that's appropriate or not, adjusted EBITDA. Okay, they never get down to the nitty gritty. And there's been studies done. How often do those adjusted metrics change a loss to a profit? A lot. A lot. You have companies that are perpetual losers, but on an adjusted basis are perpetually showing income growth, revenue growth, EPS growth, et cetera, et cetera. Nobody ever looks at the underlying and says, they're not making money, right? What's really interesting is the phenomenon recently where companies used to get away with the fact that they could be perpetual, net income losers if they had positive free cash flow. But now you have companies that are negative free cash flow and net income losers, and they create adjusted some weird adjusted free cash flow metric. They don't use the cash flow statement information.
Right. Yeah.
And so you have this sort of divorce between the reality of the GAAP or IFRS information and what people are hearing about, and especially if it's filtered through journalists.
if I understand you correctly, that a lot of investors these days and other stakeholders, they focus on the adjusted metrics more than the underlying audited financial information. Do we expect too much of auditing? If I understand correctly, they do not audit the unadjusted numbers, right? So
Right.
and they audit the stuff that we still don't really pay attention to. So, like, do
Right.
you see the issue?
So I wrote last night because of this controversy about the PCOB. So the current administration here, the Trump administration, and the people that supported, a new Trump administration and created, all kinds of manifestos, think tanks that created plans for how he should conduct the next administration. Included in those plans, fold the PCOB into the SEC.
Right.
Like, this is a regulator that nobody wanted, nobody liked, maybe has been inconsistently effective. We don't understand what they're doing. Do their inspections really support audit quality? Are they being too difficult and hard on the practitioners? Is the latest enforcement push making people not want to be accountants anymore or be partners in firm? All kinds of incentives or reasons why people said, get rid of this independent regulator and fold it back into the SEC. But effectively what that would do is that would basically kill external independent audit regulation. You'd go back to a peer review process probably, or at all. Standards would be set again by the trade association, the AICPA, and there'd be no enforcement, and the inspection regime that the PCOB has built up over time, which is pretty extensive and pretty thorough, would be dismantled. But that's not really the ultimate goal. And we see now that the minute that it looked like this was in sight, that the PCOB could actually be like kind of just completely deemed impotent, defanged, inert, folded in and disappeared from everybody's landscape, based on just no funding and no people and no mandate. They're talking now about rolling back further some of the things that were put in place with Sarbanes-Oxley to do reviews of internal controls, both management's reviews or assessments of internal controls and the auditor's opinion of internal controls. But what people miss is that this has been getting rolled back and scaled back ever since Sarbanes-Oxley was passed. Nobody liked that. The auditors charged a lot of money at the beginning until they had to stop because their clients complained. And so then they agreed, oh yeah, you're getting charged too much, but we're being made to do this by the regulator. And so you've had scaling back where categories of companies no longer have to do that internal controls opinion by the auditor or even the management assessment at all, or for a long, long time, or until they grow to a certain size, et cetera, et cetera. So I think I saw a statistic I quoted last night, Professor Bainbridge, who's a law professor, talking about the fact that probably only about 45 to 50% of public companies listed in the U.S. are subject to the 404B auditor opinion on their internal controls at this point. So now the idea is get rid of that too. It's costly. It doesn't really improve audit quality. Nobody pays attention to it. Again, a lot of academic research. Are investors paying attention to adverse opinions on internal controls by the auditors or material weaknesses in internal controls mentions by either management or the auditors? Is anybody paying attention to that and making investment decisions on that basis? Research says investors aren't paying attention. Why? Because they're not reading the Q's in the K's. Okay, they're only reading the earnings report. And of course, the management's not saying anything about that. And so you have this sort of, kind of two different worlds. People are paying attention to the details and most people who are not.
Right.
But even beyond that, you have a constituency of people who's saying, is anybody even really paying attention to the audit opinion at all anymore?
Right.
And there are people, even people who reluctantly have to admit that it's not the case, saying, maybe you bring it back to a caveat emptor. Companies have to pay for the level of audit that they want. Investors have to vote on that. And you don't have an audit, and everybody knows which companies have an audit and which ones don't, right? And you look at companies like Theranos or some media companies here that almost went public, that nobody ever asked for an audit opinion. In Theranos, there was none.
Right.
People were investing hundreds of millions of dollars in Theranos, and there was no audit opinion. Why were they willing to do that? Because certain types of investors are willing to invest money, take the shot. They'll lose the money if it's a fraud or if it's a failure, but they're willing to take the moonshot on the possibility that it'll go up, the share price will go up, it'll go public, et cetera, and they'll be able to exit, at a profit and leave the bag to the retail investors. And so there's an enormous constituency of people who say the audit does not tell us anything. Well, the audit doesn't tell us anything because, one, it's still a boilerplate report. There have been some refinements in the UK and in the US, for example, critical audit matters, or I forgot what they call them in the UK, something similar. But basically where the auditor says, these are the harder technical things that we had to look at because there's a lot of judgment or estimate involved. So, here's what we did to make sure that the company is doing things according to the standards and properly. So they highlight that stuff. However, those things have rarely been proactive. In other words, pointing to a high-risk area that does end up causing trouble. They've mostly been reactive. In other words, the company gets in trouble for a particular thing, like not reserving enough for bad inventory or bad receivables or revenue recognition aggressiveness, and then they put in this critical audit matter because the auditors have to now get on the job and prove that they're on the job. So the audit report itself is boilerplate, but also just nobody really wants to know the bad news. So why pay for an audit that oftentimes does not catch illegal acts or material misstatements, doesn't catch fraud, doesn't warn you in advance of bankruptcy, let alone, the little things, is always reactive.
Right.
It's scoped to please the client. So why pay for that audit? What we're looking for is we're looking to invest in companies that are going to go to the moon. And then you have, don't get me started on meme stocks and the fact that there is so much investing that is completely divorced from fundamentals.
Right.
Completely divorced from fundamentals. It's all, momentum. It's all just, what is exciting. It's all just, day trading and volatility. It has nothing to do with the fundamentals, and proudly so. They proudly state this has nothing to do with the actual business of the company. It has to do with trading it based on vibes and momentum. So there's a movement where people say, maybe you can actually get rid of the audit requirement, the statutory audit requirement in the securities laws, which is true in the US and in every major exchange. You have to have a certified audit, whatever that means in their country, in order to list on the exchange. Get rid of that. It's an extra expense that in particular development stage companies, pre-revenue companies, and in one case here, one of the SEC commissioners says, why do crypto companies have to have an audit? Crypto is different. It's immune to an audit. It can't be audited.
In what way? I don't follow. Why would
Well, the argument from this one person was Bitcoin and Ether, for example, are commodities. You can't audit them. The whole controversy about trying to audit the reserves of stable coins or of customer reserves in exchanges, and lots of resistance to that, and precision, and how do you do it, and when you have these kinds of assets that are highly volatile and that are not based on any kind of cash flow.
Right.
They're purely speculative. So, you know, from one day to the next, it's hard to predict. So how do you audit that and make a decision? Okay, the financial statements are fairly stated at a particular point in time when, you know, in minutes, 24/7 now, it can change.
Right.
It's really kind of stupid because you have companies now that are traditional companies that provide services or products, and they may have crypto as an asset. They may provide trading or some kind of investment facilitation related to crypto assets, but they are still operating companies with employees, with customers, with vendors, with investors, etc. And that is a economic entity, a legal entity that can be audited. So they're trying to kind of conflate the fact that the assets themselves are hard to pin down with the fact that companies are, you know, wrapping up normal operational companies, listed companies with investors, et cetera, and all the normal operational, you know, ins and outs of economic activity around some type of crypto asset trading or investment or facilitation or something like that, or custody or whatever, and saying, oh, well, maybe crypto. And again, why? To facilitate innovation, to facilitate this untethered, unfettered growth without this extra watch, scrutiny, even the light scrutiny that some audit firms are providing in some arenas. You had an audit of FTX, 2 audits. You had an audit of the FTX Bermuda Exchange. You had an audit of the FTX US environment. Did that help at all?
No.
Okay. You had clean opinions signed for these 2 distinct entities. They were missing another important entity that wasn't audited at all, and they weren't talking to each other. So they missed a lot. And that's why they're getting sued. And so you have audits and they don't help, but it's not because an audit is completely ineffective in a crypto environment. It's because the auditors chose to not, you know, ask for more information, insist on understanding the big picture, follow the standards in all circumstances, make sure that they understood what was going on in related party transactions, or push back at all because they were so excited about being in the crypto world.
Right. But FTX, were they a public company? I can't.
No, they were private.
They were private.
So the question is I always get the question, well, why did they get audits? Well, on the one hand, there was a lot of pressure at that time. People were concerned about whether companies that were in these exchange businesses or facilitating trading or holding other people's assets, et cetera, you know, in anticipation of trading, et cetera, whether they had sufficient reserves to be able to pay out customers if they wanted their money, right? Or were they doing something nefarious or trading using that money for operational purposes, et cetera? So there were a lot of questions about that. So on the one hand, they wanted to say, oh, we're audited, to reassure customers, investors, et cetera, that somebody is making sure that we're doing everything right and we've got sufficient reserves, et cetera. But the other thing is, I think, and I've reported on this, I think that they were also looking at how can they IPO. And one of the big 4 firms is actually helping them think about an IPO, which means they would have had to have 2 to 3 years of audits to file for an IPO. So that you have to start that process in advance of the time when you actually file for the IPO. So you always have to kind of be working ahead. But the audits that they got were from 2 kind of smaller regional firms that had really no significant crypto experience.
Right. Okay. Interesting. I want to touch on one more topic at least with you, Francine, if you have the time, and it's the. I mean, you've been at the intersection of accounting, auditing, financial markets, and journalism, and I know you have helped or provided some talks on the topic of how specifically accounting researchers or researchers can reach out and perhaps even build a relationship with media. And I'm very like, one of the reasons I'm doing this is that I want to be able to learn and to just gain the knowledge to be able to actually reach out with the research as well, not my own right now, hopefully in the future, right, but at least talk with people who do a lot of interesting research that never seems to get outside the academic world. So any advice from you would be really interesting to hear.
So this is a topic that has sort of grown and expanded over time in, let's say, the 20 years that I've been writing. I always was interested in research. I mean, when I was doing consulting, when I was working in the firms, etc., I was always trying to refine and improve my technical knowledge, because I never really worked as an external auditor. I was not a technical expert. I was more a practical person. I was an accounting manager and controller and all those things. But then I went to consulting, and I was using my accounting skills to support system implementations, software integration, etc. Y2K in Latin America for JP Morgan, all kinds of project management kind of stuff.
Yeah.
But when I started writing, I knew that I wanted to write with a data and a research foundation. So whether I was writing for myself or when I started writing for others, I wanted that gravitas. Why? Because I was coming from the outside, because I hadn't been like some major person in the firms or major person in academia. I wanted to add that gravitas. And so I forced myself to read and to go to conferences, start going to, and meeting people, etc., and volunteer to go out and talk to schools and whatever about what I was doing. And initially, academics were very reluctant. Accounting academics, for example, very, very reluctant. And I see that also in the economics academia. There's a sort of this bias, like if you're too out in the world, then you're not really doing academic work.
Yeah.
There's a snobbery in terms of, academia and the crude, vulgar real world, and, and
yeah.
But in the accounting world, the person who kind of broke that mold was this guy who was at Iowa, Eric Luley. Now I'm forgetting the name, but he was the one that identified the anomaly that broke open the stock option backdating scandal.
Okay.
So this is, he realized that there was some anomaly in terms of, certain executives were just incredibly timing their option exercises incredibly well, like too good to be true, right?
Mm.
And it turned out that it's because they weren't timing really well. They were backdating the options paperwork so that the pricing was completely advantageous, to the time when they would exercise.
Mm.
And so he was not like a senior, esteemed, had been published a zillion times kind of guy. He was kind of a working academic, and he ended up getting this all written up in the Wall Street Journal, and and it broke open an enormous amount of enforcement litigation against companies, executives, and in some cases audit firms who were complicit in supporting this effort. And I think it emboldened some people who had a more public service policy focused, wanted to do work that had a policy and a public service meaning to it, not just an iterative kind of, iteration on the theory. Let's find another version of, this particular, theoretical or empirical thing. And so it emboldened some people. So people started talking to me more. And others. There were always journalists who did try to talk to researchers, but, accounting researchers are kind of, again, inscrutable. When you're doing work and you're going through the same kinds of tasks, the same kinds of templates, when you're creating stuff in the theoretical framework that makes your work provides a contribution to the literature, that's not necessarily something that's newsworthy. And it's 99% of the time not timely.
Right.
There was an enormous reluctance previously for researchers to talk about their work until it was completely published in some journal. Well, you know how long that takes.
Right. Yeah.
But on the other hand, when I got to Dow Jones, to the Wall Street Journal and Market Watch in 2015, there was still a reluctance on the part of major media to mention a paper or research that was not completely peer reviewed and published. So you couldn't talk about working papers.
Right.
Okay. Why? Because you were afraid that somebody was pushing, a non-peer reviewed results. It was not ready for prime time. And, so the journalists are really, really nervous about that, right? Sourcing to a paper. That's changed, again, because of the academics' level of comfort in, I know the work I've put in. I'm going through the process of publication, or I workshopped this, or I've gotten an enormous amount of feedback. Publication is a technicality, or maybe it's only going to be an NBER paper. It's not going to be, whatever. For whatever reason, the academics, especially in accounting, who believe that they had newsworthy, actionable by regulators information results in their paper now, became willing to talk to me.
Oh, okay.
So I started talking to people like Joe Schroeder, Dan Taylor at Wharton, and any number of other academics who said, I've got something that we should be talking about now. It's going to be a while before this gets published. It's going in the process. One of my most favorite papers that I've written about more than once, because I use it as a template every time this phenomenon happens, is one that was way back and talked about when the same auditor is on both the target and the acquirer side in an M&A transaction. And it talks about, it had very, very solid results that said that the target company gets less of a premium if the same auditor is on both sides of the transaction.
That's interesting.
And even less of a premium if that audit is out of the same office. So if the target and acquirer are out of the same office, okay? What's the logical conclusion? And the bold thing is that they were not afraid to say it, which is, again, an academic bugaboo. Are you willing to say this might be happening because of this? Like to put in some type of causation instead of just association. Are you willing to actually interpret your results and give people a signal for policy or regulatory purposes? And these guys were willing to say, the only explanation for this is there's information leakage. The audit teams on the target and the acquirer are talking to each other, and the acquirer has an information advantage about the target. And so every time I see a target acquirer where it's the same audit firm, I go and I look to see, are they the same office? I go and look to see who the partners are. And I go and I do the simple model of what's the premium and compare it to their original paper. And I recycle that paper over and over again. And to great effect in terms of people internalizing, lots and lots of people that have read me over the years, internalizing that sort of signal. So that I'm training people to look at that and say, these guys matter. They're not capitalist eunuchs operating in the background. Sometimes they're acting as matchmakers because it's advantageous to their business, to their practice, to their firm. We might as well marry two companies that we audit than to let somebody else get a hold of that company and then we lose the client completely.
Right. Yeah.
And so it's a really interesting paper. So I talk to academics and say, you have to decide how comfortable you are with being outside versus inside. You have to decide where you're at in your academic career and whether you need to do papers that are meeting your fellow academics' expectations for publication and iterative contribution to the literature, blah, 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 or whether you can step out, whether you're comfortable with being in the public eye, having a quote. Many academics felt like they were going to get burned, like journalists were not going to understand what they do, so they were going to get burned. Their results were going to be misinterpreted. Their words were going to be twisted. They felt more comfortable with me. I think people started feeling comfortable with me because they really believed that I understood what they were talking about. That's a big difference. When you have subject matter experts in journalism, not just accounting, but in any arena, academics and researchers are much more comfortable talking to them, and you're going to get much more higher quality sources because you have that fear of being misinterpreted or misquoted is mitigated. So that's again the kind of coaching. It's not for everybody. And often you have academics that don't feel comfortable doing it until they get tenure.
Right, yeah.
And even when they get tenure, though, there are institutional people, and then there are bold people. And I seem to attract the people that are a little bit bolder, that want to have a more multifaceted career, that are interested in getting out there, that like to write, that want people to know what they're working on, and they tend to then direct their activities, their work, to things that can get that kind of notice. So I started talking 10 years ago to PhD students. And so even at the PhD level, you find that divide. PhDs who are more comfortable doing external things like you.
Yeah, right.
And PhDs who just want to go through the steps and follow the program and keep their head down, who have a traditional accountant, auditor personality, a risk averse, personality, an introvert, more of an introvert personality. I'm not an extrovert. Okay. I'm a learned extrovert.
Interesting.
I'm an introvert. I prefer sitting with one person at a party. You'll find me in the corner with the person who comes from a foreign country, who speaks a foreign language, who's interested in, I don't know, philosophy or something.
Right.
Okay. I don't, but I do what I do, and I've learned to do what I do because I wanted to have that kind of professional life.
That's interesting.
It's like flying a plane. You know, you can be afraid of it, but you got to get from one place to another. So you got to get on the plane. And so I do what I do because that's the life that I want. And so it's possible for anybody, but you have to be comfortable with it. And you can't, you have to understand, sometimes it can be tough. I remember there's one particular academic I remember felt very strongly about an experience that they had in a fellowship. I won't mention names, but this person will know who they are if they hear this. They had a very uncomfortable situation occur during a fellowship, and one of these regulatory fellowships, and they were just chomping at the bit to publicize it. Will I write about it? Can I get somebody to write about it? Whatever. Yeah, but here's the downside. Here's what's going to happen. Okay. You're still doing the fellowship. You're going to go back to academia, be clear what you want to do. So they hesitated, but they were really upset. So then when the fellowship was over and they went back to academia, and then they knew they were going to get tenure, they reached out without me. I was kind of surprised. They reached out without me to a major media reporter, and the reporter reported the story. And the headline was a word that the person used in their discussion. But then when they saw it in print, they realized, this is going to be a little bit controversial.
Yeah, right.
So then they're all worried about, oh my gosh, what's going to happen to me? And I'm like, you made choices. You have to understand the consequences. And frankly, you're operating in sort of a niche world anyway, even though this had major media publication, you're still operating in a niche world, and stuff happens, and, people forget and they move on to something else. But the idea was, be careful what you wish for. you may have an idea that something is burning. You have to get, the information out, whatever. But I don't ever advise anybody to blow up their career or give themselves sleepless nights worrying about what people are going to say or think of them.
Right.
You have to be comfortable in your skin, because it's going to be Googleable.
Yes.
Going forward.
Yeah.
And people are also going to have a different attitude because they're going to see you as one of those outside people versus an inside person.
But it's
and so,
I was just going to say, I think it's a great learning experience, right? Just to put yourself out there. What I'm actually trying to do as well, because I will get to learn other things which I wouldn't have learned if I didn't do this, right? So it's just the entire experience, even if it's not something, policy related and valuable, or, but just trying to get over the hill and have the sort of courage to actually put yourself out there. You will learn new things. And as you said, you could learn going from perhaps an introvert to be a learned extrovert. And I think that's very valuable, especially if you're in a field where you are creating ideas or doing research, and you want to reach the value of research and of ideas is to share them, right? They shouldn't just be sitting in a bookshelf. So I think you need this skill very much so in this type of space where you create stuff by thinking, right? So
especially when your family often doesn't have any idea what the heck you're doing. They'd say, okay, you can afford an apartment, you can afford vacations, all right, you must be okay. But in my case, my family didn't understand what I was doing, but sort of those outward things of getting quoted when I started writing. But for me, from an internal perspective, in terms of professional, like being respected in the profession, one of my greatest sort of, proud things is that over the years, if I were to look at SSRN and look for my name, I might have my name on only one or two actual papers, co-author as an actual paper, or a teaching case or whatever. But my work as a journalist is cited hundreds of times.
Yeah.
And now I also have acknowledgments. People who've said, I've helped with initial ideas, with reviewing, with guidance, with providing input, with whatever. And to me, supporting others in terms of reaching, and that my work matters. People thought it mattered. They used it not only in accounting literature, but in legal law literature. I mean, it's hard, you can't put that in words. Again, my 94-year-old mom is not going to really understand that. But for me, it's like it's a body of work that I'm very proud of.
Yeah. Yeah.
And that's what made sort of some of the awkward interactions, some of the difficult interactions, some of the ones that took time to develop the trust. That's what made it all worthwhile. And the PhD students that are now getting tenure. I've been at it long enough. It's kind of like when I first started writing, the people that were still graduate students or early associates in the audit firms, now they're becoming partners. So you look at that kind of development and that growth of people whose lives you've been involved in, where you've supported them and helped them, or where they've taken advantage of the work that you've done, and you go, yeah, okay, this makes it meaningful, makes it worth it.
Yeah, that's well put. That's beautiful. And I'm really happy that you agreed to come on this very, very, very new podcast. So I'm very happy about that. And it was I really enjoyed our conversation. I mean, we had many more topics that we thought we would be able to cover, but I think I think this is a nice place to end this conversation. I'll be happy to invite you in the future as well, and to sort of catch up, see what's happening. And there's always a lot of stuff going on, I guess, so we can always update each other. But thank you very much, Francine, again for coming on. I'm very glad to have spoken with you. I wish you all the best. Take care.
All right. Good evening to you. Okay.
Bye.